term structure or yield curve. So term structure means yield curve. So if they ask you to write a note on term structure, or if they ask you to write a note on yield curve, you can write it. So what is yield curve or term structure? So see this paragraph in your book. Come to this paragraph number part 7.1, yield curve. So when the moment you use the word yield curve, it means there is a graphical presentation of the relationship between the maturity and the YTM. As the maturity changes, the YTM of bonds also change, because bonds with higher maturity would normally but not always have higher YTM, and bonds with shorter maturity would normally have lower YTM. So by looking at this graph, this yield curve, one can estimate what is the ongoing YTM for a given maturity having similar risk, bonds having similar risk, because of course you can't compare bonds with different risk. So therefore, by looking at this diagram, suppose the maturity of a bond is 5 years, we can say this is the ongoing YTM on this bond. If the maturity is 10 years, we can say this is the YTM. If maturity is 15 years, we can say this is the YTM of this bond. So yield curve shows the graphical relationship between maturity and the YTM. So let us read first point. It is the graphic presentation of yield on similar quality fixed income security. Similar quality fixed income security. So the risk of all these bonds are same, okay, except their maturities, plotted against various maturities. Yield curve exhibits YTM of bonds similar in all respect. So the bonds which we are plotting on this yield curve are similar in all respect except their term to maturity. The term to maturity are different. The study of yield curve tells us the relationship between the term and the YTM. So you can see on this diagram, if this is the term to maturity, this is the YTM. If this is the term to maturity, this is the YTM. If this is the term to maturity, this is the YTM. With the help of yield curve, an investor can easily find out the yields that are available on the comparable fixed income securities for short term, medium term and long term. So you can easily compare what is the ongoing short term yield, medium term yield and the long term yield. So this is some basic information about yield curve. It basically shows the relationship between the yield and the term to maturity for similar quality bonds which are similar in all aspect except their term to maturity. Another theory question they will ask you, what are the different types of yield curve? What are the different types of yield curve? So first, on the first point is upward sloping yield curve. This diagram that you had seen was upward sloping yield curve. Okay, so upward sloping yield curve is also called normal yield curve, because normally, usually, in general, the shape of the yield curve will be upward sloping, hence also called normal yield curve. Here the short term rates are expected to rise in future. Short term rates are expected to rise in future. Can you see that? That is, as the maturity will increase, the YTM is also high. That means the rate of interest are expected to rise with the increase in maturity. Short term rates are lower than the long term rates. You see the diagram again. Suppose this is 5 years, this is 10 years, this is 15. Short term rates are lower than the long term rates. So what is the reason for a yield curve to show upward sloping trend? Write down reason. Write in small font because you have to draw the diagram also. So write down reason there. Good student will write quickly. Few companies want to borrow short-term funds and many investors want to invest in short-term funds. Few companies wants to borrow short-term funds, but many investors want to invest in short-term funds. So what is happening? Demand is less, supply is more for short-term fund. So short-term interest rate would be low. It's a matter of demand and supply. Interest is a price of money. If you want money, you have to pay a price called interest. So there are more suppliers of money than the demand, and therefore the interest rate would be low. At the same time, many companies want to borrow long-term funds, but the demand for long-term funds is high. At the same time, many companies want to borrow long-term fund, while few investors want to supply long-term funds. Generally, people don't want to invest for a very long term because the risk is high, the uncertainty is high in case of long-term bonds. So therefore the demand is more, supply is less. Demand is more, the supply is less for the long-term fund. What will happen to the interest rate? The interest rate will be high. So hence long-term interest rates would be high. It's a matter of demand and supply. In short term, supply is more. In long term, demand is more. That is usually we find. Then write down an upward sloping yield curve also indicates that the economy is in expansion mode. The upward sloping yield curve also indicates that the economy is in expansion mode. So there are a lot of people who want long-term fund for investing in their business, but there are less suppliers. Hence the interest rates for long-term funds are higher. So this is about yield curve note. If they ask you to write a note on upward sloping yield curve or types of yield curve, write this much for upward sloping, and then you have to also draw the diagram in the exam. So write down below diagram or on the left side if you have space. On x-axis write term to maturity, and on y-axis write YTM. And when you draw this curve, it should be an upward sloping curve, indicating that YTM is higher for a longer term to maturity bond, YTM is low for a short term maturity bond. So draw this diagram. In the exam, if theory question is asked after writing the note, please draw the diagram also. Now we'll go to second type, which is the opposite of upward sloping yield curve, and this is called downward sloping yield curve. Downward sloping yield curve is also called inverted yield curve, because here the diagram will be opposite, so it will be inverted yield curve. Means higher YTM for short term bond and lower YTM for long term bonds. Write down, these 2 points are printed. Short term rates are expected to fall in future. You can see longer the term to maturity, the interest rate is lower. Short term rates are higher than long term rate. Suppose this is 5 year and this is 15 year. So the YTM for a short term period is high than the YTM for a longer period. This situation is very rare. If you today, suppose after the class, you do some Google search and try to find out the yield curve, you will find that most of the yield curve will be showing rising curve, upward slope. Very, very rarely this situation will arise. Why? Write down the reason. Write down the reason there in short font, small font. You have to draw a diagram also like this. Many companies want to borrow short-term funds. Many companies want to borrow short-term funds. But few investors want to invest in short-term funds. So exactly opposite now. Demand for short-term fund is high and supply of short-term fund is low. Many companies want to borrow short-term funds, but few investors want to invest in short-term funds. So short-term interest rate would be high. So short-term interest rate would be high. At the same time, few companies want to borrow long-term funds. Few companies want to borrow long-term funds. So demand is low, while many investors want to supply long-term funds. While many investors want to supply long-term funds. Hence, long-term interest rate would be low. Hence, long-term interest rate would be low. So again, a matter of demand and supply, that in short run demand is more than the supply, so interest rate is high. In the long run, demand is low than the supply, therefore interest rate is low. So write one more line. Downward sloping yield curve indicates downward sloping yield curve indicates that the economy is entering into recessionary phase. Economy is entering into recessionary phase, and that is why such situation is very rare. So one more line you can add. Downward sloping yield curve indicates that the economy is entering into recessionary phase. And now you draw one diagram. So for the exam, if they ask you types of yield curve or specifically downward sloping yield curve, after writing the note, draw this diagram and it should be a downward sloping curve. So on x-axis write down term, on y-axis write down YTM, write neatly, it should look like downward sloping curve. Yes, very good. Come to point number 3, third type, which is called flat yield curve. Flat, can you see this line? That means more or less the YTM is same for all the term to maturity. Short-term rates are expected to remain unchanged in future. Short-term rates are expected to remain unchanged in future. So just write one more line there. Flat yield curve indicates uncertainty in the economy. Indicates uncertainty in the economy. So it's flat, which means your YTM is more or less same. This is a very straight line, but practically it may be just like this. Okay. So it indicates that there is a lot of uncertainty. So short-term rates are expected to remain unchanged. Term to maturity does not affect your YTM. YTM is same, almost same for all term to maturity. So these are the three types of yield curve. Draw this curve, x-axis right term, y-axis YTM, and draw a flat line, straight line, hence flat yield curve, which means the other two curves were non-flat because there the rate of interest will change.